Having a high borrowing power is very important when applying for a home loan. After all, it gives us choice to not be restrictive when looking at different houses, and it just gives us greater flexibility. If we're on a horrible rate with our bank and want to refinance but we can't because our borrowing power isn't high enough, we are essentially stuck. Or we might be property hunting and we find a house that we really like and we want to buy it, but we can't because of our situation. So what can you do? Hey guys, welcome back. My name is Fyzee. If you're new here, welcome. On this channel, we look at Australian personal finance, and today we're looking at 3 main ways to increase your borrowing power. Now, as always, we are speaking in a general sense only. This is not financial advice. I'm not a financial advisor, but I have dealt with a lot of customers across Australia, and these are arguably 3 of the main things that affect your borrowing power the most, no matter where you live. Number 1, existing debts, facilities and cards. Now, banks in Australia are fairly conservative if you compare it to other countries. And if you have existing credit cards open, it's considered a liability and it will affect your borrowing power. Because in the bank's eyes, even if you don't use the credit card and it's just lying there, maybe the last time you used the card was like 10 years ago, it is still considered a liability and it will reduce your borrowing power. And the reason why is because, realistically speaking, if you really want to, you can go out on a spending spree and max the credit card out at any time. Just because you're not doing it now doesn't mean you might not do it in the future. I know that sounds really unfair, but that's just how the banks look at it. Now, an important thing to note is that you don't actually have to close off or lower the credit card limit straight away when you speak to the bank. You just need to have the intention of closing it or lowering the limit, and as long as the lender knows, they will work off the lower figure. Now, they will only do this on the assumption that if the loan actually goes through, you will reduce the credit card or close it off and provide proof of the limit decrease or the credit card closure letter. So if you've got credit cards there with like $15,000 limits and you realistically only spend like $3,000 per month, reducing your credit card limits will actually help a lot. In fact, I'll roughly tell you how much. If you reduce your credit card limit by $10,000, you can actually increase your borrowing power by $60,000 to $75,000, and that is a lot of money. And it can potentially allow you to buy a much bigger property or find the one that you actually like. Now, just keep in mind that this is an example only. Some banks might work it out differently, so just keep that as a little guide. Similarly, the most common thing I saw was that a lot of people have these interest-free Fyzee Nauman credit cards with Latitude Go MasterCards, and this counts as a liability as well, even if it's interest-free. Now, same with Afterpay or ZipPay. Even though Afterpay lasts for 4 fortnights only, the banks will actually work it out as a liability for the whole year, not just for the 4 fortnights, which is quite unfair. So again, you need to have the intention of actually closing it off if you want to increase your borrowing power. It's the same thing for line of credits. They just work off the credit limit. So again, it's best to have the intention of closing them off if required. Number 2, which is employment status. Now, generally speaking, full-time and part-time work is preferred by the banks because, well, it shows stability and that work will be ongoing for you and it will be consistent, especially with this whole COVID situation. But that doesn't mean that if you're a contractor or working casually, the banks absolutely don't trust you at all. Don't get me wrong. If you're working casually, generally speaking, the banks will work out your income by looking at how much you've actually earned this financial year. So for example, 1st July 2020 to now, and then they will take that figure and they will annualize it to actually work out how much money you will earn this whole financial year. Now, with this overall projected income for the year, some banks will shade your income even further to 48 weeks or even 46 weeks. So what that means is that even though you may have worked for the whole 52 weeks of the year, the banks will look at it as you have worked only 48 weeks or 46 weeks, and they will go off the lower amount. Now again, why do banks do this? Because casual is considered less stable than other employment types, because sometimes you may have irregular hours and whatnot. So basically speaking, my whole point is, if you have the option to go part-time or full-time and you're currently working casual, generally speaking, it is better to take the option. The part-time option will give you more choice and potentially give you higher borrowing power as well, if all things are considered equally. If you earn the exact same income working casual or working part-time, the part-time option will generally work out better. Now, number 3 is to actually reduce the amount of kids you have. So currently, if you have 3 kids, if you can potentially reduce your kids to 2 or 1, you can actually I'm just kidding, don't do that, that's very bad. Actually, number 3 is to refinance or consolidate your debts. Now, this won't apply to first home buyers, but if you're a first home buyer, just listen anyway because it might help. Because it may be quite likely that later on down the track, once you buy your own house, you might want to buy a couple of investment properties down the track. So in that case, this will be quite important. So guys, if you didn't actually know, your borrowing power can be different with a range of different banks. So just because one bank can lend you 400k, it might mean that the next bank could lend you 390k or even 410k or even a bit more than that. Now this actually depends on a variety of different factors, so I can't actually tell you which bank will have the highest borrowing power. Now over the last 2 years, as a result of the RBA cutting rates back in mid-2019 and recently at the end of 2020, the banks have actually reduced their mortgage rates, but along with that, they have actually reduced their servicing criteria as well, which means that if you applied for a loan a few years ago and you got rejected because of borrowing power, it might mean that you can potentially even get the house and you can potentially borrow more as well. Now, let's say that you want to buy an additional investment property at the moment. You currently have a home loan, which was a 30-year loan term when you first took it out. And now 5 years have passed and the loan term is now 25 years and you want to buy that additional property. It could be helpful to refinance your original loan from 25 years currently to 30 years again. That way you can get some extra borrowing power to buy your next property, plus you might even get a rate drop and a cashback as well. Now of course, just keep in mind that you will pay more interest, and I understand that you might not want to pay off the home loan in 30 years, you might just want to stick with your original plan of 25 years as it is now, and that's completely fine. What you can do is just keep on paying the same amount that you were paying previously and pay the same amount on the 30-year loan term, and you will be on track to pay it off in that same amount of time. If you're on a variable rate, the extra repayments should generally be fine with your bank. So that's one thing you can do. Just keep in mind that if you actually end up paying the home loan off in 30 years, rather than the original 25 years, you will pay more interest. So if you are planning to do something like this, it might be best to get a second opinion from a broker. Plus they can check your borrowing power out with a number of banks as well to give you that peace of mind. But if you've never actually used a broker before, you might be a bit anxious to actually go through with them and give them all your personal details. And that's completely understandable, which is why I made a video about the top 3 questions you should be asking your broker to make sure that they are working in your best interest, because that's the most important thing. There's a link in the description and there should be a pop-up on your screen as well, so go check that video out. So guys, just as a final comment, I just want to say that if you were able to borrow $500,000 a few years ago, it doesn't actually mean that you'll be able to borrow the same amount right now. Because since then, a lot of things may have actually changed. Maybe you got more debt, maybe you have a lot of credit cards, maybe you have more kids, so it always pays to get a second opinion on this matter. So hopefully now you can get the house that you potentially want without being restricted to the borrowing power issues, and you can finally enter the property market. If you guys found value in this video, please like and subscribe, it really helps out. I make regular videos about personal finance, investing, home loans, so stay tuned. Thanks for watching guys, see you in the next one. And the reason why is because